Welcome to Private Market Valuation Mistakes, how investors overpay or underestimate risk. In the high-stakes world of private equity and venture capital, accurate valuation is paramount. Mistakes here can cost millions, even billions. The private market is a minefield of potential missteps. Understanding valuation pitfalls isn't just about avoiding losses, it's about securing future gains. Accurate valuation serves as the bedrock of successful private equity and venture capital investments. It ensures that capital is deployed efficiently and risks are appropriately managed. Mispricing investments creates a detrimental ripple effect, impacting everything from fund returns and firm reputation to the overall health of the entire portfolio. Let's delve into some of the most common valuation pitfalls that can derail private market deals. One major pitfall is over-reliance on a single valuation method, whether it's discounted cash flow, market comparables, or precedent transactions. Each method has its limitations, and using only one provides an incomplete picture. Beware of inflated projections, especially the notorious hockey stick revenue charts. These often stem from overly optimistic assumptions rather than realistic market analysis. Another mistake is ignoring market cycles. Failing to adjust for interest rates, sector trends, or regulatory shifts can lead to significant misvaluations, regardless of a company's internal strengths. The value of intangible assets is frequently overlooked. Intellectual property strength, customer stickiness, and brand value can be crucial differentiators that are often missed in traditional valuation models. Finally, hidden liabilities pose a significant threat. These can include off-balance sheet debt, pending lawsuits, or undisclosed regulatory risks that can severely impact a company's true worth. Now let's explore why relying on a single valuation method can be so problematic. Inflated financial projections, often driven by overly optimistic assumptions rather than market realities, are a common pitfall. These hockey stick forecasts can lead to significantly overvalued deals. Ignoring current market conditions and broader economic trends, such as interest rate fluctuations or sector-specific shifts, is another critical error that can lead to severe misjudgments in valuation. Overlooking intangible assets like intellectual property, customer relationships, and brand equity, as well as failing to uncover hidden liabilities such as pending litigation or environmental risks, can lead to a dangerously inaccurate valuation. To underscore these points, let's look at some real-life case studies where valuation mistakes played a critical role. First, the Blackstone and Hilton deal. This was a massive private equity acquisition that offered significant lessons. Blackstone acquired Hilton at the peak of the market cycle just before the 2008 financial crisis. While Hilton eventually showed remarkable resilience, this case highlights the immense risks associated with cyclical timing in large-scale private equity deals. Next, the complex private equity transaction involving Dell and Silver Lake. The Dell/Silver Lake deal illustrated the immense complexity of valuing a company undergoing a major technological transition and a going private transaction. It emphasized the challenges of assessing a company's long-term potential amid significant strategic shifts. Finally, Quibi, a stark example of the consequences of overvaluation. Quibi lost billions, proving that immense hype and capital infusion do not automatically translate into product-market fit or sustainable success. It underscored the critical need for a grounded understanding of consumer demand and market viability. The WeWork IPO saga is a classic and more recent example of an inflated valuation unraveling under intense public and market scrutiny. It highlights how quickly market sentiment can turn when fundamental business models don't support the valuation. So how can investors safeguard their investments against these pervasive valuation mistakes? Always employ a triangulation approach, using multiple valuation methods like DCF, comparable transactions, and asset-based valuation. This cross-checks assumptions and provides a more robust estimate of value. Base your projections on verifiable evidence and thorough due diligence. Tying forecasts to actual market data and industry benchmarks, rather than speculative growth, is crucial. Conduct enhanced due diligence. This means going beyond financial statements to perform deep dives into legal, regulatory, operational, and even reputational risks that could impact valuation. Engage external experts for third-party validation. These independent professionals can stress test your assumptions and identify blind spots, providing an unbiased assessment. Let's reiterate the importance of employing multiple valuation methodologies. Basing projections on verifiable evidence and thorough due diligence ensures that your financial forecasts are rooted in reality, not just optimism. This is paramount for accurate valuation. The market landscape has shifted, ushering in a new normal with different implications for valuation. The market is moving away from purely top-line valuation and towards a greater emphasis on sustainable growth. Investors now prioritize profitability and stable unit economics over rapid, often unprofitable, expansion. Overvaluation can lead to unrealistic operational pressure and forced growth strategies. Companies might engage in unsustainable practices to meet inflated expectations, which ultimately harms long-term viability. Engaging third-party experts to validate your assumptions and projections is an essential safeguard. Their objective assessment can uncover blind spots and strengthen your valuation. Higher interest rates have driven a significant shift from growth at all costs to a strong focus on profitability. Investors are now scrutinizing business models for sustainable earnings, rather than just top-line expansion. When a company is overvalued, operational strain often follows. Management and teams are pushed into unsustainable growth strategies, leading to burnout, compromised quality, and ultimately, a breakdown of the business model. A failed valuation can severely erode investor confidence, making it difficult to raise follow-on capital. This can trap companies in a cycle of underfunding, hindering their ability to execute their vision and grow. In this new environment, focusing on fundamentals is more important than ever, and AI is emerging as a powerful ally. The ultimate safeguard against valuation mistakes is to focus on the company's core product, its market, and the strength of its team. These fundamentals determine long-term success, not just short-term hype. Artificial intelligence tools are revolutionizing due diligence by spotting anomalies and red flags that human analysis might miss. AI can process vast amounts of data to identify unusual patterns or discrepancies in financial records. A failed valuation can severely erode investor confidence, making it difficult to raise follow-on capital. This can trap companies in a cycle of underfunding, hindering their ability to execute their vision and grow. Ultimately, success comes back to basics: strong core product, demonstrable market demand, and a capable execution team. These are the true drivers of sustainable value. AI's edge lies in its ability to recognize complex patterns in financial data, detect potential fraud, and benchmark performance against industry standards at a speed impossible for humans. Furthermore, AI-powered predictive modeling can forecast various scenarios based on real-time data, offering a more dynamic and nuanced understanding of potential risks and opportunities. Navigating private market valuations requires vigilance, a multifaceted approach, and a focus on fundamental value. Remember, this content is for educational purposes only and not financial advice. Always consult with a qualified professional for personalized financial guidance. Thank you for watching.